Well, good afternoon. It's Thursday, January 21st, and my cohorts are on the screen with me this afternoon. We want to thank you for participating in our webinar. My name is Jeff Shelton. I am the founder and president of Shelton Financial Group, and we just want to thank you for taking the time to participate. Some of you have really good video, and you'll be able to see our charts today. Some of you are joining us without great video or maybe even on the phone. We want you to know that regardless of the medium that you're using, that we want you to be able to understand our comments. So there will be a few charts, really only 10, that we'll talk about. And all of these charts will be available on our website. If you go to our website, there is a JP Morgan Guide to Markets book. And there's actually 81 charts, 81 pages in that. We're going to be using 10 of those today. So when we're done, if you go to our website, you can print that off or look at all of the charts that we look at today. I believe we all understand there's a big difference between facts and opinions, data versus interpretation of that data. And I suspect you're going to hear some of both today. The printed charts will be the data. Those are the facts. Our comments are our interpretation of the data. Maybe our comments are educated and influenced by years of experience, but they're still just our opinions. We encourage you to think outside of the box. At the end of today's event, I will share some new and exciting ways that SFG hopes to be able to help you do that. And finally, we live in a supercharged political environment today, more so than ever before. My team and I will do our very best today to leave any political bias or opinion out of our presentation. We work for you, and our goal is to give you quality and unbiased information so that you can make responsible and educated investment decisions. We have diverse political views within our office and within our client group, and we believe we can respectfully and professionally serve investors who have differing viewpoints. In fact, we can work with both IU and Purdue fans, Yankee and Dodger fans, and even Colts and Patriots fans. So, having said all of that, let me jump in. I have assigned a topic to each of our 4 advisors that you see on the screen with me. Brian Newland, Al Linston, and Matt Fry are all sitting in our Fort Wayne office in their private offices, joining us via Zoom. And Nathan Shelton is sitting in our Ossian office, joining us. A year ago, we would have never been able to do a technology program like this. So I want to do a special shout out to Pearson Harnish and Dan Easley from our office, who have worked a lot of hours to improve our technology deliverable. That's why we're able to do this today. So Pearson and Dan, we really appreciate your ability to help us communicate better with our clients. At the end of today's presentation, I'll give you my personal 10 predictions for 2021, and we hope to have all of this wrapped up within about 30 minutes. So let's get going. We're going to start with Brian Newland today. Brian, one of the fundamental concepts that you learn in economics class is that price is usually a function of supply and demand. When something is sought after or in high demand and people are wanting to buy it, the price goes up. We saw that last year when the public started buying mass quantities of things like face masks, cleaning supplies, and even toilet paper. Demand went up, people wanted to buy those things, and the prices naturally moved higher. Give us some insight into how that fundamental concept works when it comes to the markets.
Jeff, thanks again for having us on today. But yeah, the markets generally work the same. Have the same principle and the same concept. So as a stock becomes more popular and more in demand, the price of that stock continues to go up, and that's why we would typically see, the markets go up. Same thing on the inverse side. If there's less of interest in it and there's more supply than there is demand, then that price will come down. So yeah, it correlates very well to that example. Actually, the chart that I picked for today really talks about fund flows from last year. And this is from mutual funds, ETFs, and such. And if you look at the top left corner of the chart, where it shows, where the cursor is here under U.S. equity. You can see that we had about $203 billion of funds flowing out of U.S. equities. And then below that, we had another 40 billion that was flowing out of the world equities. So where was that money going? Obviously, if we continue down, we're looking at taxable bonds, saw a fairly significant increase in inflows. So the money that was coming out of the stock market was really going into the bond market. One of the drivers for that as well was last year we saw some interest rates that were dropping. So whenever we see interest rates drop, typically bond prices will go up. So that was a positive for people to go with their money, especially as the pandemic was surging in the early part of the year last year. And as we all know, the stock market tumbled quite a bit, and that's where a lot of places went. But if you go clear to the bottom of that, where it shows liquidity, there was 684 billion that went into just cash. So there was a lot of money that went to the sidelines last year, and actually has stayed in that area. So there's still quite a bit of money sitting to the sides and also in the bonds as well. But again, kind of to your point though, with as far as supply and demand goes, last year it was really the FANG stocks that saw most of the money inflow. So as we look at, well, the stock market looked like it went up last year, but if you look at where the money really went, it went into those FANG stocks, which obviously drives the S&P 500 and the Dow Jones.
Yeah, when I look at this chart, what's amazing to me is we all know that 2020 was a bad year and people got out of the stock market at some point. Go back and look at 2008 on this chart. It's surprising to me that as bad as 2008 was, people really didn't bail out nearly as much as they did in 2020. There was some additional reason why investors just got out of the market. Maybe that was because the market dropped so fast or so hard. Maybe it was political in nature. But even 2008, we didn't see that kind of movement out of the market, did we?
No, and one of the reasons for that as well is that if you remember, 2008 was a much more drawn out decline, where this past year it happened in literally 2 weeks. So again, I think that instantaneous fear factor kind of helped to provoke that.
Yeah, I would agree with that. Thank you, Brian, for those thoughts.
Yep.
Al Linston, I've often said that we can't control the wind, but we can reset our sails. And really the premise of this thought is that we can't predict what's going to happen in the markets. There's just no way. But if we pay attention to what's happening, maybe we're able to make changes in the portfolio and we might capture some additional performance by making those changes. The phrase used in the industry is things get long in the tooth, or green sprouts are coming. So what are the trends that are changing? What do we see that's beginning to develop some momentum today that really didn't have momentum previously?
So, Jeff, you mentioned all the supercharged political rhetoric that we have today, and it's so easy to get caught up in it and let the emotion of it control your investment decision making. I would just encourage the investor to keep politics out of your portfolio. Look at the data, look at the market fundamentals, look at the trajectory of the economy, look at corporate earnings, and let that drive your decision making. So with that being said, let's just look at some of the trends that we're seeing today. And we are seeing some pretty dramatic trends that have just recently occurred. We have the first chart here is looking at small cap versus large cap stocks. So if you look at small cap stocks, you're going to look at the S&P 500, well, the Russell 2000 for small caps, and for large caps, you're going to look at the S&P 500. And let's look at what happened in the fourth quarter of 2020, rather. Fourth quarter of 2020, the Russell 2000 was up 29.3%, but the S&P was up 12.15%. And we thought, hey, that's great for the S&P, but the Russell 2000, it just snuck up on us, and it's just going crazy. Same thing for 2021. So far, year to date, now this is only a couple weeks, but through January 15th this year, the S&P is up a little less than 1%, but the Russell 2000, the small caps, are up 7.5% just in a couple of weeks. So that trend seems to be continuing. So if we look at this chart here, I want to call your attention to the lower right-hand corner specifically, where we're looking at historical markets drawdown and the next 12-month rebound. Take a look at the tech bubble, going back to 2000 to 2002. Take a look at the global financial crisis, going back to the 2008 time period, and look at what happened the next 12 months when the market rebounded. It was the small caps that led the way. So the thought is that small caps are doing some of that same type of thing that occurred in the tech bubble and the global financial crisis. The vaccine is expected to be more of a benefit to small cap companies. And if you look at the left-hand chart here, you can see where a lot of the sectors that are expected to lead the way out of the recovery are dominated by small cap companies, financials, industrials, materials. So keep that in mind as we go to the next chart, which indicates the trend that we're seeing in large cap versus growth stocks. So if we can go to the next chart, we'll see on the left-hand side, we're going to look at PEs, price to earnings. If you have a higher PE, it's typical of a growth stock. If you have a lower PE, it's typical of a value stock. And here we're looking at the ratio of growth stocks, PEs, versus value stock PEs. If you have a negative number, it's basically saying that value stocks are cheap, growth stocks are expensive. That's what's happening today. So in my mind, there's a lot of opportunity here. Value stocks, they've been out of favor for, my goodness, 12, 13 years. It's been a long time since value has outperformed growth. And they were significantly beaten down during the whole COVID period last year. I mean, there's a huge disparity between growth stocks performance and value stocks performance. But it's expected that financials, materials, industrials, they're expected to benefit from the vaccine, as well as government stimulus and legislation that's going on right now. These are all segments of the market that have a value bent. FANG stocks, that's all we could talk about last year. Facebook, Amazon, Apple, Netflix, Google, everybody wanted it, and they couldn't get enough of this stuff. Well, we're expecting to see still a lot of demand for those types of stocks. They're going to continue to be attractive, but there's some headwinds here that are coming up in 2021 that we didn't see in 2020. One of those things being some possible antitrust legislation that could really curtail some of the performance of those. We've got cyclical stocks, which are typically value stocks, travel, banking, auto. Those are all considered value type stocks, and they've had to adjust through the crisis with aggressive cost cutting, with inventory control, and a lot of gains in efficiency. Well, all of that and the balance sheets that they have now because of all the cost cutting that they've done is going to serve them well in the recovery as demand comes back. We also have a low interest rate environment. That's a good that is a good indicator or a positive indicator for dividend paying stocks. And typically a dividend paying stock is going to be a value stock. So that definitely is a trend. The other trend that we're seeing is in domestic versus international. I think there's some opportunity in international in 2021, in particular emerging markets. We now have, I think, a little bit more predictive trade policy with the Biden administration than we had with the Trump administration. That may be favorable to emerging market stocks. There could be some additional pressure on the dollar, and when you have a weak dollar, the local currency is typically stronger, and that benefits commodity exporting countries in particular. Asian markets have been opening up. They've done a good job of controlling the virus and restarting their economies. So I think there's going to be some opportunity in international that maybe we haven't seen up until the last few months. So those are three of the big trends that I'm seeing.
Yeah, I gave you three difficult concepts to try to explain, Alan. So I'm going to try to step back a little bit and simplify what you said, because these charts can be kind of complicated for the average investor. So you identified three categories. The first one was, should we buy big companies or small companies? For a long period of time, which of those two categories were the best?
Oh, large cap, for sure, yeah.
And what you're suggesting is, recently we've started seeing movement towards smaller companies, right?
Right.
So we're seeing a movement from large to small that may or may not continue, but it has started. The second one was growth and value stocks, stocks that are either expensive or inexpensive. For a long period of time, which of those perform the best?
Oh, growth has been outperforming for years.
And it's really been in the last 3, 4, 5 months that we've seen value start to overtake that, correct?
Right.
And then the third category you gave us was US or outside the US. For a long period of time, which one was performing the best?
Domestic, US has been outperforming international, yeah.
But we are seeing a movement towards international that's, at least in the recent term, which again, this is only 3 or 4 months out. We're not talking years. This is a fairly short-term momentum change. Who knows if it's sustainable, but it's moving from domestic to more international, right?
Right.
How long does a trend have to happen before you make a change in a client's portfolio?
You know, typically we have some really good managers of our strategies, and we typically rely on the expertise of those managers to make those adjustments for clients. And we're seeing a lot of that happening right now. I mean, in our BlackRock strategies, in our Horizon strategies, and our Goldman Sachs strategies, there has been some tilting towards some of the value and some of the small cap. Still probably more of an emphasis on the growth side and the large cap stock side, but some additional exposure to some of those more opportunistic plays that are coming up. So if there's anything outside of that, then the client and I would have to look at the data, and if the client and I feel like, hey, we need to add some more of that exposure ourselves, then we'll make some decisions to maybe change some strategies. But
so we do have
rely on our managers.
Yeah, our active managers are doing that. BlackRock, Horizon, Goldman Sachs, there's an element of that. But some clients are invested in models that will not make those changes. They will stay large growth domestic all of the time. If you're buying an S&P 500 fund, it's not going to go small value or international. So it's another reason why you need to know what you're invested in. Thank you, Al. That was great information. Matt?
You're welcome.
Matt, there's a lot of conversation today, both in the industry, I guess, really, and in the general public, about the amount of money being printed around the world by virtually every nation. Deficit spending is the phrase. For you and me, deficit spending can only happen in our households for a short period of time, and it's really limited by outside forces. Governments don't seem to have any limitations on how much they print and for how long. Historically, long-term debt has led to some increase in inflation. I think both of these are connected in some ways, deficits and inflation. Help us understand this issue, Matt.
Yeah, absolutely. First, just want to thank everyone again for joining us today. Thanks for taking the time out of your day. So Jeff mentioned two of the big hot topic issues right now, deficits and inflation. I'd probably throw a third one in there with interest rates, and they're all sort of tied together and connected. So if we look just at deficits first starting out, if you look at the chart that we have up on the screen, it's page 33, I believe, in the JP Morgan slide. If you look at the top right, the bar right next to the dotted line, that was what kind of the deficit, what happened in 2020. And we all know what happened with the pandemic and the amount of stimulus that took place. An interesting fact that we saw, the amount of stimulus that was pumped into the economy in 2020, it was actually about 2.5 times the amount of stimulus that we saw back in 2008 and 2009. So it was a tremendous amount of money that just got pushed into the system. if you look internationally, Germany and Japan, two other countries, they had 10 times the amount of stimulus that they had in 08 and 09 is what the stimulus was in 2020. So just all around the world, we saw a tremendous amount of money get pumped into the system. And in addition to that, we saw the Fed get really involved really quick last spring. They added about $3 trillion of assets to the balance sheet, just going in and buying a bunch of stuff up again, just to pump money into the system. So really, anytime we see that amount of cash flow or infusion of money into the market, you're going to see inflationary pressures. Everyone will hopefully take that money, and the idea is that you go put it into the market. If that increases demand, that's going to increase prices, some of the things that Brian kind of talked about. But now if we switch gears and look at inflation, we have another chart that will look at kind of historically what inflation has been and where we're at today. And you can see here that the average inflation rate we've seen over the last 50 years is about 3.8. We're nowhere near that right now. We're down in the low 1% range. The Fed has come out and said that they have a target of about 2% for inflation moving forward. I do expect that we'll see inflation start to tick up. I don't think it runs away from us. Also, keep in mind, a lot of times when we look at inflation, the data points are year-over-year comparison. So when we see inflation data in March and April of this year, it's going to be comparing it to 2020. We know what happened then. So kind of keep everything in check. I think overall we do expect inflation to increase or move higher, but maybe over a longer time frame. I think the other thing that I would add is, the Fed and the government has been through this before after 08 and 09, so they have the tools in their tool belt, and they kind of know how to use them in order to keep inflation in check. And I think the other thing that, we typically say inflation and interest rates are sort of tied at the hip. I think, if you look at the chart, it's actually chart 37 in the JP Morgan slide. We don't have it available today, but interest rates are historically low right now. And I think it will have a similar movement as inflation. We will start to see inflation tick up, and then eventually we'll start to see interest rates move higher. But I would definitely anticipate both of those to probably remain lower for a little bit longer.
Yeah, I had a client send me an email and say, how do we think the national debt that we're accumulating is going to affect our children and grandchildren? And frankly, I don't know that the government really cares about that right now. I think they're just trying to keep the wheels on the track and kicking that can down the road. We'll just deal with that some other day. Is that the perspective you have?
Yeah, the phrase that I heard is that the Fed's not even thinking about any of those implications. And so I think it's both with the debt and inflation, is that they are doing everything they have to right now. And we're seeing more stimulus being talked about and even being pushed out into the economy now. So yeah, it's something they will have to deal with, but they're just focusing on the here and now right now.
Yep. And again, all of these charts are in the JP Morgan book that we have available on our website. We picked out 10 that we're talking about today. There's many more that we would love to jump into, and Matt mentioned one additional one. Thank you, Matt. Appreciate your time. Last on our list is Nathan Shelton, who again is sitting in our new Ossian office. Nathan, some investors right now are just afraid that things that we would normally invest in, like stocks and bonds, they're just not going to perform very well for the next period of time. Maybe those are political biases that they have, or maybe there's some other basis for that, but they're just afraid of the regular types of investments. Some say the stock market and the bond market are overpriced and they're actually due for a major pullback. What advice would you give an investor who wants to invest in something that's less traditional?
Well, thanks for the question, and excited to engage here today. I would say greetings from Ossian, and for those of you that have not been down to our new building, we'd love to have you and show you around. We've got a beautiful vault here as well. That's we haven't yet closed the door, so maybe if we do a door closing ceremony, we'll have everybody down. But nonetheless, we'd love to have you do our new office. Really, back to your question. It is a great question, and we often find investors and clients asking similar types of questions when there's maybe an increased fear or doubt or significant uncertainty in the market. And really the question, I think, phrased another way, this idea of non-traditional assets or asset classes would also be phrased as something non-correlated to the market. If we think stocks and bonds, which are the traditional asset classes, are overpriced or not somewhere that we want our money for whatever reason, what are the alternatives that we have to choose from? And actually, that's another phrase used, is alternatives. To jump into the chart here, I think Matt did a fantastic job of explaining both the interest rate environment and the inflationary environment that we'll likely find ourselves in for at least the next few months, if not years to come. And that would really apply to the bottom left-hand corner of this chart, where we have a low and rising inflationary environment, low interest rates, rising inflation over time. If we look at different asset classes and how they've performed in those types of economic environments, you can see the traditional bonds, cash, high yield, and then equities, growth, value, small cap. A lot of these Al talked about. The blue and the green chart here would indicate the traditional asset classes. The gray bars are going to be the alternatives. And this is where we start talking about gold or real estate or commodities, or one that's not on the chart but that we hear of from time to time is Bitcoin, or some of these cryptocurrencies. Something that gives us growth opportunity, but different types of exposure than we would have normally had in the market. And if we look at specifically gold and real estate and commodities as these alternative or non-correlated type of assets, I think it is important to understand there are unique risks associated with those growth options. And if we flip to the next chart, I think one of those risks is naturally we're less familiar with these types of asset classes. We might have the S&P 500 or the Dow Jones ticking across the bottom of our screen all day, but maybe we don't have all of the different commodity prices that we can see as readily. I think the chart on the left here, if you look, is a great representation of what I'm talking about. These are different types of commodities that we might be able to invest in, and gold down at the bottom. If we really focus on gold, to break down the chart specifically, the black bar running left to right on your screen shows the low price and the high price over the last 10 years of this specific asset class. And the line running down the middle at 0 is the average price over that time period. So we can see gold, for example, while it's something we've had a lot of interest in, I would argue is probably overpriced, or certainly at the top end of the spectrum when it comes to what would be considered affordable. And these prices are going to move over time with the economic conditions that we've talked about. But these non-traditional asset classes, while they can provide varying returns from what we might traditionally see in the market, there's certainly some unique risks that come along with them.
Yeah, that's great, Nathan. I think of this in the farm ground example. If you buy farm ground in Northeast Indiana today, it might be $6,000, $7,000, $8,000 an acre. But if Amazon comes along like they did at the airport and decides they want to put up a building like that, you're now getting $20,000 an acre. So although historical price today is relevant, it doesn't mean that it can't go higher. It just means you have to recognize that you're taking additional risk for it to go higher. And Pearson, go back to the previous chart, because Nathan, this is one of the most relevant charts I think that we're showing today. There's 4 possible scenarios of what can happen with interest rates and inflation. And these 4 scenarios, we're clearly in that bottom left quadrant. Correct, Nathan?
That's correct. Absolutely.
So we're in low inflation, and it's most likely rising. Now, we can fight the wave of that, but that's the likely scenario that we see ourselves in. So great job, Nathan. Thank you for that information. As we kind of wrap things up today, I'm going to give you my 10 predictions for 2021. I think the rest of the guys are all going to come back on the screen now. Keep in mind, these are Jeff's predictions, not Matt's or Al's or anybody else's. This is what I think is likely to happen as I sit here on January 21st of 2021. I'm quite sure some of them won't happen. I just don't know which ones. But today, if you asked me to take a stand, make a prediction, here's what I would tell you. Number one, I think stocks will perform better than bonds in 2021. Number two, I think our GDP increases. I think inflation increases considerably. It might even double this year. Interest rates stay flat and employment improves. Number three, I believe commodities, hard assets, and alternatives will perform better than domestic stocks. I think that's somewhat of a controversial position, but that's what I think should happen this year. Number four, oil prices are likely to go up, which should be a tailwind. It should help energy stocks. We're already beginning to see some of that now. Number five, emerging markets over developed markets. Al talked about this, I think, a little bit in his comments. Smaller, less developed economies are likely to grow faster than more developed economies. At least that's my prediction. I think the US dollar will weaken throughout the year. Number seven, I think government spending plus dovish Fed policies will be a tailwind or a benefit for domestic stocks. So I'm sure not saying that domestic stocks won't perform favorably. I think they will. I think they'll perform better than bonds. I'm just hanging my hat today on emerging market stocks and or alternative commodity-based positions. Number eight, I think there's a market correction coming, probably 10 to 20%. I don't know when, I don't know how long it will last, nor do I know how bad it will be. But I would expect to see some market pullback at some point this year. Number nine, because of Al's nice charts, I'm going to predict that small caps will perform better than large caps. Value will perform better than growth, but only if investors stop piling money into FANG stocks. We're just blindly buying Tesla. No matter what the underlying value of that stock is, people just keep buying it. If that continues, then I think large growth will perform better this year. But I do think there's going to be an understanding and perhaps a momentum change as the year goes along. Number 10, I'm betting on real estate over domestic stocks. I think that's another controversial position, but that's my position. And I'm going to give you two bonus predictions because I know you're dying for them. Number 11, I think the taxes go up. I think they go up for many people in their personal income taxes. I think they go up for corporations. I think the estate death tax stepped up in basis is likely to go away. That's on the table. And I think capital gains rates will go up for everybody. Those are tax increases. Whether you agree with them or not, we have to figure out how to invest our money if those things happen. And number 12, another trend that I think you'll see changing. In the past, you've been able to passively invest in indexes. You could buy the S&P 500 and just make as much money really as almost any other type of investing. I think you might see that change in 2021. I think active managers like BlackRock and Horizon and Goldman Sachs that move between large cap and small cap, not completely in and out, but they have leans or bents, more small cap or less small cap, more value or less value. I think those active managers will begin to perform more favorably in 2021 than they perhaps have in the past. So those are my 12 predictions. If you want more, if you want to hear from the experts that we work with, I encourage you to go to our website. We're right now in the process of having available on our website 2021 market forecast from 4 of the largest money managers that I know. BlackRock, the largest investment manager out there. Goldman Sachs, Horizon Investments out of Charlotte, North Carolina, and Bob Dahl, one of the all-time great money managers. We're going to have their forecasts available on our website that you'll be able to see. Right now, BlackRock is up there. The other 3 are going through our compliance process so we can make them available to you. I encourage you to go on our website and look at what they have to say, because the data is the data, but how we interpret the data can be very different from person to person. I really do hope you'll take the time to listen to those podcasts and videos that we have on the website. It's 12:36. We didn't quite stick to our 30-minute deadline, but I want to thank you for participating with us today. If you have questions for us, please send those in. If you have feedback on how this format went, this is the first time we've done it this way. I know we're throwing a lot of information out very quickly, but frankly, if we go much over 30 minutes, most people really don't want to participate. So our goal is to keep it interesting enough, provide the information that you'll find valuable, but also make it reasonable in the amount of time. So if you have some comments, please give those to your advisor. You can email us so that we kind of know what's going on. We'll have some other events available for you as we go through the spring here. Be looking for those. I guess on behalf of Al, Brian, Matt, and Nathan, I just want to say thank you for participating.